All right, hey Dr. G, this is Jamion Lewis, getting ready to discuss my Calaveras winery. Um, Looking forward to discussing it with you, so let's get started. All right, so as far as the background and history, um, Esteban Calaveras founded it in 1883 to make wine for the Catholic Church. By the 1950s, it expanded its production to table wines and the Calaveras family through the 1960s and 70s. They continued to run the vineyard there, but they made some production changes. Um, and they owned about 220 acres there in California. 175 acres of that land were strictly for vineyard fields. Uh, Ownership changed three times. Significant changes were noted in the case 1986, 1990, and 1992. And throughout those changes, each time the owner changed, essentially marketing changes happened. And it was noted in the case. Um, so it's just a little history and background in regard to the vineyard. Let's discuss the case problem. So in 1994, um, Anna Clemens, the senior vice president there at Golden Gate Capital, was reviewing a loan proposal from Tom Howell from basically a bank investment group individual. They were describing the proposal, and basically um, it was for lending 4.5 million in acquisition for Calaveras. There was a $2 million term loan offer and a $2.5 million revolving credit. As you know, Dr. G, a term loan is for a specific amount that has been specified repayment schedule, either fixed or floating interest rate. This one had a fixed rate that we'll discuss further in the case, and then also the revolving credit. It's a line of credit where I guess the customer pays, that commitment fee to borrow money when the funds are needed. So Clemens needs to make a decision in this case, and that's basically what the case problem is. Clemens' decision, reviewing the financials and the projections of Calaveras, and basically making that decision. She needs to make that decision if it's worth, you know, her investing in. Is the estimator worth sound, based on the financial proposal? Are the numbers correct? Is the growth projections correct? And does it make financial sense for her to invest and and you know take the deal that was offered to her? So as far as wine products, there was five different types there, or estate wines. They were offered, made and bottled at the winery from a few selected varieties. They were sold in that super premium category. Another wine that was sold in the super premium category, excuse me, are the selected vineyard wines. They were made for grapes purchased from selected vineyard and aged and bottled separately to preserve uh, their characteristics. So that was another super premium wine. California wines, they're made from medium quality wines. They're Calaveras. Uh, it was noted there that they were declining in importance because they were able to highlight and focus on estate wines and selected vineyard wines. So the shadow of those California wines was really falling in the shadow of those other two previous mentioned wines. And then the generic wines that they made were from lesser quality products. And the special accounts wine, they were made from a surplus. They were the low quality wine. Um, and they were sold to airline, hotels, and church parishes as noted in the case. So that's just a little background information in regard to the wine products. Let's move on to their performance. And so this was their revenue percentage as of 1993, and so I gathered this information from the case. You can see the different wine types there and what their revenue percentage was. The significant ones there, the state wines, Sauvignon Blanc, also from the states, that Cabernet Sauvignon, the Chardonnay. We'll talk about the Chardonnay specifically when it was introduced, but from the selected vineyards there, 30%, that's pretty significant. And then the special accounts red and white wines, they're doing 16.6%, that's combined, so that's still a significant number. All right, so the market history. So the owners of the market, of Calaveras, aimed to move out of the bulk wine category. They did so by introducing 3 different types of wines in 1987 to enter into the premium category. That Sauvignon Blanc, Cabernet Sauvignon, and that Petit Syrah were introduced to enter into the premium category. And in 1990, they also introduced the Chardonnay into the premium category. So they really wanted to step out of the bulk wine category and enter into that premium category, and they did successfully. Once they were established there in that premium category, they had another management strategy change. They also, it was noted in the case about a cautious price increase, and they also developed a special account segment to use their lesser quality wines. So that's where they were moving as far as their history in the market. And now their current market, so they plan to adopt a new marketing company. It was noted that 2/3 of their sales were through wholesale distribution, which of that 2/3, 60% went to restaurants, 40% went to high-end retailer outlets, and then 1/3 were sold directly to some special commercial accounts. Overall, within that wholesale distribution, there were 9 distributors who handled about 80% of their volume. I thought it was pretty significant that only 2 distributors there in California made up 50% of that overall volume. That's pretty significant. So the other 7 are making 30%, which is really insignificant compared to those 2 other distributors there in California. So the remainder, that last 1/3, right, was sold to commercial accounts, airlines, hotels, etc. And the current market, it was noted that the demand for alcohol was stagnating nationwide, that the supermarket sales did see an increase of 7.4% due to sophisticated selections and better merchandising techniques. That's what was noted in the case. So yeah, that's where the market is at the time of the review. So let's talk about some financial projections. So Ernst and Anderson developed the financial forecast. The first year was expected to rebound to the 1992 sales levels. So that's pretty significant. Their maximum wine capacity is 110,000 cases per year, so they're limited in that aspect. Clemens assumed that $350,000 investment per year, she liked that over the recommended $250,000 per year. What was noted or provided in the case, and then the real growth percent rate of 2%, which is really significant. It's great, but is that truly sustainable? I'm not 100% sure. So, but looking at Martinez's past success, and then the market, the competitors, I think it's feasible, but is it an accurate depiction of what Calaveras will do in the upcoming years. At the time of the case, it's not for certain. So yeah, we're going to discuss profit margins. What else in the financial projections do I think those were all of the highlights. Yeah, so that was just the projections that were provided, discussed in the case. But that real growth rate of 2%, if that is true, that's significant because that's really going to play a key part in Clemens' decision making in regard to participate and accept the deal or not. Profit margins, okay, yeah, this is good. So profit margins, it was projected that the gross margins will rise to 40%, which is feasible based off of the industry's average, which was 39.6%. So it could get there, but not for certain. In 1993, they yielded 28%, so they plan to uh, increase their prices there, so that may attribute to that projected rise of 40%. But still, at the same time, you would probably increase your prices higher than the rate of inflation. 12% increase and the gross profit margin may be too optimistic for Calaveras, just because they yielded 28% the year prior. So I think that's a lofty goal and an optimistic projection. All right, so earning before interest and taxes, EBIT, got the sales revenue projected out in the forecasted income statement there going to 1998. You can see the cost of goods sold for those different wines in those accounts, and then the total there, the overall total, um, shouldn't be in red. My apologies on that. Um, and then the gross profit of what they make, the difference there. And we see the costs, selling, general, and admin expenses there, and then amortization and organizational costs. That brings our earning before taxes, or before interest and taxes there at the bottom row there. And you can see that the company is profitable from an earnings standpoint, so the earnings look decent. Free cash flows. So also use this forecast looking throughout 1998. We got our EBIT, what we collected there in the previous slide. Got that information from the case. The tax expense rate there is 37%, so we subtracted that from the EBIT, and which brought our net income there. So you can see that they are profitable from that standpoint. We're going to look at depreciation there, amortization that was noted in the case, and then the less change in net working capital. So we subtracted those amounts from the net income, and we also subtracted the capital expenditures that were noted there in the case. So in 1994-95, we used the 250,000, but 96 through 98 we increased by 100,000, 350,000, and that gave us our free cash flows there at the bottom listed. So 1995 through 98 is looking decent. All right, so for liquidation value, I reviewed all of their assets, gave a high and low value estimation, went back and forth on a few different things because land varies in price, and I did some market research, but basically I think it comes down to low estimation is 5,000 per acre, high estimation is 10,000 per acre, and I just did that. So the low value is the 175 acres that actually have the vineyards on it, and the high value is including the the low value was at 5,000, and then the high value is at 10,000, but that's all 220 acres. And then for the inventory, use 75%. Kept that for the high and low value that was noted in the case. So I just pulled that information directly over. Plants and equipment, 40%, which was noted at the case, which was noted in the case. The number won't change. Cash, which is low, right? 50,000. Low cash there. Accounts receivable, low, noted in the case as well. 85% of it, which is zero. And then that brings our totals, right? So a high value total, 4.1 million, low value, 2.8, and liquid assets. Some notes that I placed there. The high value estimation does clear the 3.1 million debts starting there at closing. Excuse me, I'm battling a cold. The low value estimation, so sorry, is $317,000 short of the debt at closing, so that doesn't cover the cost. So that's something to consider. And then the land, I would say, is the key value driver of the liquidation value, just because of the price. You see the significance there that I've listed, and also land will not depreciate. So just key points there. I'm going to move on to the credit analysis. So I use the 5 C's to review the credit proposal or the credit worthiness of Calaveras, and I would say, especially at the surface level, when I initially reviewed, I'm like, yeah, this sounds right. It sounds like it's a pretty good offer. But until you do some research and analysis, there's just some uncertainties there. But as far as credit, the 5 C's, looking at the character, Martina's the manager there. She has proven track record of success. I think she's the perfect person for Calaveras. So yes for her. Capital, the projected capital gains look great. Like I said, I shouldn't say great. They look good. And potentially, Calaveras can have those returns just like the other, individual companies that were viewed in this case in that industry. They could be there and operate, commensurate with them. From the cash flow standpoint, I would say, yeah, it was a low price offered for what Calaveras was initially, or the case valued Calaveras at, and the free cash flows is significant, especially in the later years, or excuse me, in the future years. The collateral, 2.8 million of liquid assets at the low valuation point, right? It doesn't cover that loan cost, but there again, looking into the future, and land, it's not going to depreciate. It's not a depreciating asset. So that's something to consider. And the conditions, there's a lot of product mix changes. There's been a lot of changes. Well, I should say a lot, but there have been changes in ownership, which brought along, management strategy, marketing strategy, market execution, product execution. So there's a lot of changes there, and that's just something to be cognizant of as you build a brand, But overall, I would say yes, Calaveras is credit worthy. Now we will discuss some more of the financials and those offered amounts in more detail as we move along. Oh, sorry, went back a slide. So the WACC, or weighted average cost of capital. So the unleveraged beta I got these numbers from the case, and based off of our text, we have to get that unleveraged beta from an average of three firms or peer firms, um, and so that's what I did. Got the unlevered beta there listed for the three. Finn and Sawyer is the most closely related to um, Calaveras, and that's why I chose to use that WAC of 12.72%. Um, but the average WAC there at the bottom is 11.59%. The industry average debt and equity, that's that average market value to debt and equity ratios, and it was actually given in the case, so that was an easy kill. The marginal tax rate was given in the case. We used that 37% throughout. The leverage beta, we used that formula out of our text. They're listed on the right hand side. And let's see here, the equity market premium, that was given in the case text as well. What else do we have? Risk-free rate. Noted that there. We use 5.85% across. Keep saying we, me. Cost of equity, listed that going across. That varied for each. Given in the case, the equity, market premium, and risk-free rate were both given in the case. Let's see here, cost of debt before tax. Got that information out of the case as well. Clemens, she wanted to use that 9.5%. So they went 0.25% lower is what she wanted. What was recommended was that 6.75%, and that was for prime, and the offer was 3% in addition to prime, which brought the total to 9.75%. But Clemens decided to bring that down 0.25%. Cost of debt after tax was straight across the board. And we use that weight of debt and weight of equity. Keep saying me. I use the weight of debt and weight of equity. That formula on the right there to come up with those numbers provided. So 0.14 across the board and 0.86 across the board for equity. Very simple. And then the WACs provided there at the end. And like I said, I chose to use 12.72% WAC just because Finn & Sawyer is the closely related size to Calaveras. Discounted cash flow analysis. So we got our EBIT there at the top, our tax expense. Excuse me. Tax expense there at 37%. Subtracted that, we have our net income, depreciation, amortization. I subtracted net working capital listed there, and also subtracted those capital expenditures, and they changed there from 94, 95, 250K to 96 through 98, 350K. And then you see our free cash flows. See my free cash flows that I provided there. Terminal value came out at 10 million, so that's significant. And the total there, the free cash flow with added to the terminal value brought it at 10.83 million. Rate of return 26%. Discount rate 13%. Present value came out at 6.85 million. Debt, as stated, 3.122 million. The equity value came at 3.73 million, and provided that investment equity there, and that brought me to 2.73 million as the net present value. Then looking at this case, you really need to look at the strengths, weaknesses, opportunities, and threats. So I developed the SWOT and noted their strengths. They have a long history and a pretty strong brand position. They have a solid distribution process, and they have a large availability of product categories. They operate in a bunch of different categories, and they have lots of skill and experience with their management staff, um, the, the experience levels, and some of their work history was noted in the case, and so that I thought that was pretty significant. Their weaknesses: the cost per unit of production is not stable. That varies, right? Um, the predicting their profit revenues, there's some difficulty there. It's not certain. It's not certain. Um, sorry. They listed, their projected figures, but there's a lot of variations that play a part into that, um, and it's hard to say for certain that you'll be there, that Calaveras will be there. They have that limited sales volume. Their vineyards can only produce that 110,000 cases per year max. And there's also long processing time for some of their products. Um, some of those select products take a longer time, and so the lag time there is noted as a weakness. As far as opportunities, they definitely have a pretty good stake now in the higher quality product category. They do have, or it was noted in the case, to have a new marketing strategy, so that's a good opportunity for them to expand on. They created that specific segment to leverage their low quality products. They're going to induce that cautious price increase, so that's something they could leverage. And then also the supermarket sales increase of that 7.4%. That's also an opportunity for them to expand and build off of. Now, as far as threats, their capacity, they're limited to that set number, and it really didn't speak on expansion opportunities in the case. So we're going to say or I'm going to say that that's a negative, or excuse me, a threat, right? Because there are other large wineries in the market, especially in that premium category, and we don't know what their expansion capabilities are. There's limited cash flow for covering expenses up front there. 50,000 in cash isn't much. Unpredictable supply of grapes. The weather seems constant, but the supply, if there's any issues, and especially if you're utilizing different types of grapes, you don't know how they're going to do that season. So it's unpredictable, right? And then higher quality product category competition. I think I noted that earlier, but there's other vineyards there, and wineries, I should say, that operate in that higher quality product category, and there's a lot of competition. So that's just a threat. So the value of Calaveras, looking at the DCF and WAC, 12.72%, value them at 6.852 million, as noted my spreadsheets above. And then that liquidation of assets value, and the low value 2.8 million, the high value 4.13 million. So the valuation, depending on where you look at it, it does cover the starting loan cost, but there's uncertain growth projections that were noted in the case, and that 13% margin increase in 1 year. I know that the other that some other wineries in that industry are getting close to that, but that doesn't necessarily mean that Calaveras is going to make that up with a price increase. So, in conclusion, I feel as though that Calaveras is too optimistic with their growth expectation. It was noted in the case that alcohol sales were sluggish nationally. I know that they can build on the supermarket, uh, that 7.4% supermarket opportunity, but that's just one outlet. So I wouldn't put all of my eggs in that one basket. The feasibility to introduce more equity than debt is challenging in this case. I would, if I were to take the deal, I would need more equity up front. I would request more, at least $1 million more. You could probably get away with $750,000, but I would want an additional $1 million. I would, or it, I wouldn't, but another possibility would be to potentially sell some premium stock, and you can bring on some other investors, but at the same time you're adding debt. So that brings us to that main bullet point of being able to introduce more equity than debt. It's tough at this point. Um, but that's a possible opportunity. And then also, if the forecasts are true that were noted in the case, you Clemens would return, a high return on investment. She would yield a high return on investment. So, if they are true, but getting there and making them true presents a lot of challenges. Um, for those numbers to be true in the projection in the case, you would have to raise prices above the rate of inflation, and that's going to affect the real growth. And the terminal growth rate is in my opinion, the deal make or break for me, because I feel like it's a key driver of the valuation. Um, the terminal growth rate and the discount rate, it's not as significant. The terminal growth rate is really what I look at, because they can make a huge difference in the company's value. And if that rate increases or decreases, that could potentially make or break the deal for me. I feel like the terminal growth rate needs to be larger uh, for me to participate in this. So ultimately, with all the uncertainties provided, I'm not saying that Clemens is getting a bad deal or a bad offer, because based on the valuation of the company, I think it's a decent offer. But due to the uncertainty and where the numbers are currently at, their profitability now, it's too uncertain. Their projections are too uncertain for me to participate in the deal. So I say no deal. Dr. G, thank you for another great semester. This was my Calaveras case. Thanks for bearing with my voice, and I appreciate it. I'm just battling the cold, so thank you kindly.